What if I told you that DGRO, one of the most trusted dividend growth ETFs, has faced a 3.28% drop over the past month? This sudden downturn has left many investors asking, is this a warning sign of deeper troubles? Or could it be a rare buying opportunity for long-term growth? Stay with me as we analyze the reasons behind DGRO's decline, dive into its numbers, and discuss strategies to help you make the most of this situation. DGRO, an overview of the ETF, the iShares Core. Dividend Growth ETF, DGRO, is designed for investors seeking exposure to high-quality companies with consistent dividend growth. DGRO has been a favorite for income-seeking investors due to its low expense ratio of 0.08% and diversified exposure across multiple sectors. Expense ratio, 0.08%. Yield, 2.12%. Net assets, 31.31 billion. Price range, 52 weeks. 53.11, $65.08. Despite its consistent track record, DGRO has seen a 3.28% drop over the past month, raising concerns about its resilience in the current economic climate. What's driving DGRO's recent decline? To understand why DGRO is experiencing this downturn, we need to examine both macroeconomic factors and fund-specific challenges. 1. Macroeconomic pressures. The broader market has been heavily influenced by the Federal Reserve's hawkish stance on interest rates. As the Fed maintains higher rates to combat inflation, Treasury yields have surged. For instance, the 10-year Treasury yield has climbed above 4.8%, its highest level in years. This has made fixed-income securities more attractive to conservative, income-focused investors, diverting funds away from equity ETFs like DGRO. In addition, GDP growth has slowed to 2.1% in the last quarter, reflecting a cooling economy. Consumer spending has also declined, further impacting DGRO's key sectors like consumer defensive and consumer cyclical. Second, dividend yield. Disparity. DGRO's trailing 12-month yield of 2.12% now pales in comparison to short-term Treasury ETFs, like the iShares 1 to 3-year Treasury Bond ETF SHAY, which offers yields above 4.6%. This disparity has prompted many investors to pivot towards safer fixed-income options, reducing DGRO's appeal. DGRO's sector. Breakdown and challenges. DGRO's diversified portfolio includes exposure to multiple sectors, but its concentration in certain industries has made it vulnerable to current market headwinds. Sector weightings. Financial services, 19.86%. Rising borrowing costs and narrowing profit margins have affected key holdings like JP Chase, 3.21%, and Citigroup. These challenges are compounded by economic uncertainties and tighter credit conditions. Technology, 17.50%. High interest rates have reduced the attractiveness of growth-oriented tech stocks like Apple, 2.86%, and Microsoft, 2.80%, which are among DGRO's top holdings. Healthcare, 15.94%. Regulatory pressures and rising costs have impacted healthcare giants like Johnson & Johnson, 2.49%, and AbbVie, 2.28%. Industrials, 11.65%. Supply chain issues and higher input costs have constrained industrial companies like 3M and Honeywell. Consumer defensive, 10.01%. Inflationary pressures have affected consumer spending, impacting stocks like Procter & Gamble, 2.17%. Top 10 holdings of DGRO, 26.06% of total assets. DGRO's top holdings reveal its commitment to high-quality dividend-paying companies. JP Chase and Company, 3.21%. ExxonMobil Corporation, 2.92%. Chevron Corporation, 2.87%. Apple Inc., 2.86%. Microsoft Corporation, 2.80%. Johnson & Johnson, 2.49%. The Home Depot, Inc., 2.29%. AbbVie Inc., 2.28%. Broadcom Inc., 2.18%. The Procter & Gamble Company, 2.17%. These companies represent a mix of stability and growth, but their sector-specific challenges have contributed to DGRO's recent struggles. Key technical indicators. A closer look at DGRO's technical metrics provides additional insights into its performance and potential future movements. Price movement. DGRO's price has dropped 3.28% in the last month, declining from $65.08 to its current level of $62.15. While this may seem like a modest decline, it represents a significant pullback for an ETF focused on stability. Relative Strength Index R. DGRO's RSI is approaching oversold territory, signaling that the selling pressure may soon subside. This could indicate a potential reversal in the near term. Moving averages. The 50-day moving average is trending close to the 200-day average. If the 50-day average crosses below the 200-day average, it could form a death cross, which is typically viewed as a bearish signal. Volume trends. Trading volumes have remained elevated, reflecting heightened investor activity. This could indicate capitulation, which often precedes a stabilization or rebound. Opportunities for investors. Despite its recent decline, DGRO remains a compelling choice for certain types of investors. Let's explore how different strategies can be applied based on your investment horizon. Long-term investors. For those with a long-term perspective, DGRO's focus on high-quality dividend growers remains attractive. Its low expense ratio and diversified portfolio provide a solid foundation for generating steady income and growth over time. Historical data suggests that dividend growth strategies tend to outperform during periods of economic recovery, making DGRO a viable option for patient investors. Short-term traders. For tactical investors, DGRO's current levels may present a buying opportunity. However, caution is advised given the potential for further volatility. Monitoring technical indicators like RSI and moving averages can help identify optimal entry and exit points. Strategies to navigate DGRO's decline. Here are 3 actionable strategies to consider in response to DGRO's recent performance. 1. Diversify your portfolio. To reduce sector-specific risks, consider complementing DGRO with other dividend-focused ETFs that have different sector exposures. For example, SCHD offers exposure to high dividend-yielding companies with strong fundamentals. VIG focuses on companies with a history of increasing dividends over time. 2. Implement dollar-cost averaging. Investing in DGRO at regular intervals allows you to average out your purchase price. This strategy helps mitigate the impact of short-term market volatility and ensures consistent investment growth over time. 3. Rebalance your portfolio. Evaluate your current asset allocation and consider reducing exposure to underperforming sectors. Rebalancing allows you to align your portfolio with your financial goals and risk tolerance. Potential risks to consider. While DGRO remains a strong long-term investment, there are risks to keep in mind. Continued rate hikes. If the Federal Reserve raises rates further, fixed income securities may become even more attractive, drawing more capital away from DGRO. Economic slowdown. A prolonged economic downturn could negatively impact DGRO's core sectors, reducing profitability and dividend growth. Sector concentration. DGRO's heavy exposure to financial services and technology could make it more vulnerable to sector-specific challenges. DGRO's recent decline underscores the challenges dividend-focused ETFs face in today's economic climate. However, it's important to remember that market downturns are temporary. With a disciplined approach and well-thought-out strategies, investors can turn these challenges into opportunities for long-term growth. Whether you're a long-term investor or a short-term trader, staying informed and regularly reviewing your investment thesis is crucial. DGRO's focus on high-quality dividend growers, combined with its low expense ratio, makes it a valuable addition to any portfolio. especially for those willing to weather short-term volatility. Are you holding DGRO? How are you navigating this dip? Let me know in the comments, and don't forget to like this video and subscribe to the channel for more insights into dividend investing.